The new tax laws and the impact on real estate. Hi, I'm Scott Saunders, and I'm a Senior Vice President with Asset Preservation, Inc. We're a leading national qualified intermediary. And what we're going to talk about are these new laws and the impact on real estate. Just as a start off and an important clarification, everybody should review their unique facts and circumstances with their own tax and legal advisors because everybody has a different situation. But what I want to do is just briefly unpack some of the aspects of these new rules, because at the end of the day, these were very favorable for real estate. Real estate got a lot of big things out of these new tax laws. And so there are 940 pages of rules. I'm just going to focus on the ones that relate to taxes and then to the real estate market. But here's some takeaways. We definitely had certainty that was restored, and that deals with an important subject to us, 1031 exchanges and retaining them as they've always been in the code, with things like carried interest and the capital gains tax. Second, we now have 100% bonus depreciation, and this is a big benefit. I'll unpack this in a few minutes. We've got the QBI deduction, the qualified business income deduction, that has now been made permanent, and that's a huge win for millions of real estate partnerships. The estate tax exemption doubled, and that at the end of the day, that's going to allow more of your wealth to stay with you and with your heirs rather than potentially being subject to some very steep taxes. The state and local taxes, what's referred to as SALT, this was dramatically increased the amount that can be written off there. And that's a help for individual property owners. And then we've got favorable rules with businesses on that. So that's a change, something that a lot of people wanted to see improved and enhanced. And it was in a very significant way. A few other takeaways. The tax laws encourage building new manufacturing facilities. So factories, we're going to see that really be a revitalization of that and really more onshoring of manufacturing to America. Now, that'll take a few years to really get into full speed, but that's a benefit. The opportunity zone rules, what are sometimes referred to as OZ, these are now also made permanent, and the rules were now expanded. And so this provides an avenue for people that have capital gain of any type, whether it's on real estate or other assets, to defer that gain, and then even for people that hold for a longer period of time, for over 10 years, to actually have tax-free gain on assets that are held over 10 years. The low-income housing tax credit was expanded. So that's going to encourage more affordable housing development, something that's desperately needed in this country. There was a fix with some ways we do accounting for condos that is going to increase the supply of condominiums. And then finally, there were some clean energy incentives that were in the Inflation Reduction Act that was passed a few years ago. Those are not going to go away, but they're going to be kind of winding up, a lot of them, or sunsetting. And the end of the day then is really more of a restoration and focusing on return on investment. So those are just a big overview. I'll unpack a few of these. Now, what we got out of this tax law, and it's referred to as the One Big Beautiful Bill. You probably won't hear me use that anymore, but that's what it was formerly called. I'm just going to refer to it as the new tax laws. The big thing is we now got permanence. Businesses and investors don't do well when things fluctuate and when there's uncertainty. It's hard to make a strategic investment of capital for the long term when you don't really know what the rules are going to be down the road. Now we've got permanence with a lot of these rules, with tax rates and with different things. So that's going to help businesses to be able to make capital investments. It's going to help investors to be able to plan for the long term as well. One of the things it did is it extended a lot of the cuts that were going to be expiring. So if we hadn't had any changes, a lot of the provisions in what's known as the Tax Cuts and Jobs Act, referred to as TCJA, those were going to expire at the end of 2025 unless something happened. This also allowed President Trump to make good on some of his promises, or at least, make an effort to make good on those things like taxing of tips and overtime pay and income for seniors on their Social Security. So at the end of the day, we now have a lot more certainty, and that's a really important aspect. One of the things these new rules bring into place is a new incentive for work, rewarding work. So things like overtime pay for the next few years, that you're going to have a cap on that up to $12,500, not going to have to pay taxes on. And this is on the federal level. On tips, there are no federal taxes on the first $25,000 in tips. So these are things, and I want to be clear, these are federal taxes. There's still going to be state, local, and payroll taxes. But there is a rewarding of people that work extra, whether they're working overtime, whether they're working for tips. And then the SNAP program, which is referred to as food stamps, so it stands for SNAP, Supplemental Nutrition Assistance Program. There are going to be new work requirements imposed on those that are able-bodied and can work. So some takeaways here for real estate. One, those that are looking up to save for their first property or maybe their first investment, they're going to be able to save money a little faster if they've got tip income or overtime. Number two, for renters, if you're renting to people that are in these types of categories, you're going to have a little bit more, they're going to have a little bit more take-home money, disposable income. So think of areas that are near concentrations. You know, a city that comes to mind right off the bat would be Las Vegas, Nevada. Casinos there, lots of people working for tips, restaurant industry. Those areas are probably going to thrive with these new rules. So that's something to look at. Now, the new legislation did not make any changes whatsoever to Section 1031 tax deferred exchanges. In the past, there have been some recent attempts to restrict and to cap 1031 exchanges to a certain amount that can be deferred each year. There is no changes at all with Section 1031. The carried interest rules remain the same. Capital gain tax rates remain the same, 15% and 20%. And the net investment income tax is still 3.8%. So again, we've got some really important provisions in the code where nothing changed at all on these things. Now, a big change was restoring bonus depreciation for qualifying property and leasehold improvements to 100% bonus. Any property acquired after January 19th, 2025 is eligible for the bonus depreciation, and it's permanent. It's not going to sunset. It's not going to phase out. This is a big win for real estate investors and also for business owners too. Now, I want to point out there are no changes going back retroactively back to 2023, or 2024. But this is a meaningful incentive for people to do this. And really what the impact will be, this is good for commercial real estate because a lot of commercial property owners might upgrade to much larger assets to get the depreciation benefits. The residential market, the transaction volume's been pretty soft, down from what has been historically. And this is going to give people an incentive, again, to upgrade if you're a single family rental investor. And then another segment that's got a lot more traction over the last few years are what we call short-term rentals, things like Airbnb, those types of properties that are rented short-term. These properties can qualify for something called the short-term rental loophole, where an owner can qualify for the bonus depreciation a little bit easier than meeting that real estate professional designation. So big benefit for commercial real estate, residential, and for short-term rentals. So one of the challenges when you do bonus depreciation is you're going to take that depreciation now, immediately in the year of acquisition. That's going to have a bigger tax hit down the road. Well, we have the perfect solution to that. You can do a 1031 exchange and defer all those taxes. So the strategy would be take advantage of bonus depreciation today, if you're eligible for that, maximize your return on investment today and at the time of purchase. Then down the road, when you're going to be selling and disposing of that asset, take advantage of a 1031 exchange and then take all of that equity, redeploy it into other like-kind property. And that way you combine both strategies and you really get the best of both worlds doing it that way. There's some other provisions, and I don't want to go on too long. I've got a PowerPoint deck here that I'm going to include for everybody. I'll go through these fairly quickly, but you've got an extension of the qualified business income, or the QBI deduction, which is a 20% deduction for qualified pass-through income. Big benefit for a lot of real estate partnerships. It doesn't apply to every LLC or partnership, but it is a big benefit for the real estate industry. Now, this one is huge. Increasing the estate and gift tax exemption from up to $15 million per person, $30 million per couple. That provides a lot of certainty, and it's going to make it a lot easier. The SALT, the state and local taxes, this is something that was increased now for homeowners, for people that own property, from 10,000 today to 40,000. It'll go up by 1% annually to 2029, and then it's going to go back to the old 10,000 cap. But for the next few years, up until 2030, we now have a much higher SALT deduction. That'll phase out for the higher income earners. And then it is fully deductible for all business related and state and local taxes on the business side. So the other piece is this legislation now, there were some workarounds with what are known as pass-through entity workarounds. Those are all allowed in all the states that brought those into play. I already touched upon this. We're going to have 100% immediate expensing for a very limited, narrow category. These are going to be factories and manufacturing facilities. This is going to encourage the development of those types of properties. Some things to be aware of. These have to be owner occupied, so they can't be leased. So owner users are going to benefit from this in a big way. Then I'm going to wrap up, and you can watch the rest of the PowerPoint with some of the headings, but opportunity zones are a way to take your money and invest in these areas where we've got distressed, lower income levels, areas that need redevelopment. And so these were previously put in place, came about because of Senator Tim Scott, and they attracted a lot of capital, but these were set to phase out, and they're in the code now, but they were going to phase out. Now, beginning in 2027, these are a permanent part of the code, and they'll just roll. So somebody who does a transaction where they've got gain, they can put their money into one of these developments, into what's called a qualified opportunity zone fund, that's then going to go in, redevelop real estate in these distressed areas. And if that money stays there for 5 years, 10% of the gain goes away. And then money that's there for 10 years or more, any of the new gain is 100% tax free. So governors can designate all these tracts. They did lower the type of property that qualifies. It's got to be where the median income is 70% of the statewide median income. It used to be 80, so they're going to make it a little more distressed. And the second one is there's a benefit now that they'll be encouraging development into a lot of rural areas. So an incentive to some of these areas where you just have the populations are not as strong and there's not as much going on economically. There's an incentive to encourage investing in those types of places. I'm going to wrap up here. And if you've got questions on this, certainly talk to your tax advisor. If you've got questions on anything related to Section 1031 exchanges, please call Asset Preservation at 800-282-1031. Visit our website, apiexchange.com, or give us an email, info@apiexchange.com. And we want to be a resource to you if you're an investor. If you're an advisor, we want to be a resource to you too on anything related to 1031 exchanges.